If you are not a millionaire yet, then this video was made for you to watch and learn from. That way you can build a plan for yourself. That way you can actually achieve the financial dreams that you have. That way you can take better care of yourself, you can take better care of your family, and you can take better care of your community. Growing up, I always wanted to have money. But in my culture, that was almost taboo. And my parents always told me, don't talk about money, don't worry about money, and don't think about money. But at the same time, I would see my parents go to work every single day and work their butts off with very little vacation. If my dad had a Saturday and a Sunday off, that was considered a long weekend. So I saw them always talk about how money's not important, but at the same time, I saw how hard that they worked. And so I wanted to change things up. I said, well, if we have money, then you won't have to work as hard. That's when I started to go on my financial education journey to learn how I could have some money. That way we could have more financial freedom. Now, I was very fortunate. I was never poor. I never had to worry about my next meal. I was never worried about being broke or anything like that. But I wanted to give back to my parents. That was the initial thing that drove me down this financial education journey. And then as I started to see more success, as I started to make more money, then it became a different goal, more of a purpose. More of a, wow, we are never taught about money. How come we're never taught about money? I can't believe that I went through all this schooling. I went through college. I went through a year of graduate school. I then went through law school. I did everything right. But I never once learned a thing about money. And most of us go through this system. We go through doing everything right. We check all the boxes, but we never ask, whose boxes are we checking? Because if you want to become financially successful, because we all go to school to get a job so we can become financially successful, well, the thing you have to understand is just because you have a good job or you have a good degree or you have a good profession doesn't mean that you're going to be financially successful. In fact, they're two completely different things. Financial success is about your financial education. This isn't something that you get in school. Your career success is what job you have or what career you have. That's completely separate. You can be rich, but hate your career. You can have a good career, but not be rich. Now, if you want to be financially successful, which is what I'm going to be talking about here, you have to understand the financial education. And there are 6 steps that you have to take in this order if you want to be financially successful yourself. And number 1 is understanding that you have to build that growth and wealth mindset. And this might seem kind of like, Jaspreet, what are you talking about? What does mindset have to do with becoming financially successful? Well, I can tell you this. If you do not have the right mindset, if you tell yourself that I can't be rich, if you tell yourself I cannot become successful, if you tell yourself that somebody who looks like me can't do it, if you tell yourself that somebody who has the upbringing that I had can't do it, you're right. I guarantee it. You will never be able to see the success that you want because you told yourself that you don't. But if you change the way you think, if you believe that you can become successful, if you believe that you can do it, well, now nothing can stop you. Growing up, I was told time and time and time and time again, there's somebody who looks like me. There's somebody who knows nothing about business because no one in my family is a business person. No one in my family is an investor. No one in my family is one of these types of people. That nobody like me should be able to go out and do it. In fact, I should just study and become a doctor because that's what a good person from India, a good Indian family, a good Indian kid, a good person like me should do. But I decided to do something different. I was the dumb one who decided to do something different. And during the decade of me trying to figure it out, I looked like the dumb one. But then once I figured it out and I started to see more success, then everybody kept asking me, how did I do it? How do I achieve more success with money? How do you invest your money? How do you do all these things and do the things that you have now? Well, you can't ignore all the 10 years that I had to go through to get there. So the first thing is you have to believe that you can do it. The way I put it is you got to be willing to be stupid. Because if it wasn't for me being stupid, I wouldn't be here talking about this. Money is just a tool. It amplifies who you are. If you give a good person money, they have a tool to do more good. If you give a bad person money, they have a tool to do more bad. That's why we need more good people with money. Money is just fuel. It amplifies you. It doesn't change who you are. If you have bad intentions, more money is going to amplify your bad intentions. This is why I keep saying that money is really emotionless. Money is not a good thing or a bad thing. It's just paper. It just is. It allows you to do more of the things that you want. More money isn't going to make you happy after a certain point. Yeah, if you're broke, if you don't have any money, more money will definitely make you happy. But more money is not going to change the anxiety or the depression that you have if it's something deep-rooted within you. This is where you have to understand how money plays a part in your life. More money isn't going to fix the relationships that you have with your parents or with your spouse. You have to understand that these are all different things. Money has its own place. More money will fix more financial problems problems. It will allow you to buy more things that you like. But you have to also understand how money plays a part in your life. Because if you don't have money and you keep putting up these smoke screens saying money is bad and money is taboo and money is evil, well, now you're the one that's stressing to pay your bills. You're the one that can't afford to go on a vacation. You're the one that can't give their spouse the vacation that they want. You're the one that can't give their kids the education that they should get. And you're the one that can't afford to take better care of your parents. This is why it's important for you to actually go out and get the money. Once you understand step number 1, which is the mindset, then you can move on to step number 2, which is knowing how to save your money strategically. If you have no savings, like the majority of Americans do, the very first thing that you need to do is you got to save $2,000 as fast as humanly possible. If you do not have $2,000 saved up right now, you are in a financial danger zone, because if something goes wrong, if your car breaks down, if your AC breaks, if your heater breaks, if your window breaks, if something goes wrong, well, now you're going to have to go into debt to fix that problem. And now you're going to have to dig an even bigger hole to dig yourself out of the problem. You need to save $2,000 as fast as humanly possible. Cut back on your expenses, work to earn more money, and sell some things. Do whatever you got to do to save $2,000. Put it in a checking account, put it in a savings account, just put it in an account that you don't touch unless it's an absolute emergency. This is the beginning of your emergency savings fund. Once you save the $2,000, the next thing that you got to do, which is a part of this step, is you got to understand the power of compound interest. Because let's assume now that you start by investing $8,900 the day you turn 21. Somebody gives you $8,900 and you invest this money, and you can get a guaranteed 20% return on your money year over year. And you do this for about 40 years, which is, the course of your career. Well, if you do that and you never invest another penny after you invest this $8,900, well, you are going to retire a millionaire. Not just a millionaire, you're going to retire a multi-millionaire with over $13 million in your bank account. If you can maintain these types of returns and you never invest another penny again after you invest this $8,900 when you turn 20 or 21. Now you might be thinking, but Jaspreet, where in the world am I going to get a guaranteed 20% return on my money year after year after year? Well, let me show you somebody who's doing it right now. Your credit card company. If you carry any credit card debt, you are the one that is making your credit card company richer year after year after year. So the second half of laying your foundation is first building a little bit of a savings cushion, but then digging yourself out of this financial grave, because credit card debt is skinning you alive. If you have any sort of this type of high interest credit card debt, you got to pay it off as soon as possible. Don't worry about investing your money in the stock market. Don't worry about putting your money somewhere else. You need to pay this debt down as fast as humanly possible. The average stock market return is 7 to 10% a year. Why are you trying to invest your money in the stock market and get a 7 to 10% return a year when you could get a 15 to 25% return by paying down your credit card debt? Step number 3 is you got to start putting your money to work. See, what wealthy people do is they create a system where anytime they earn money, their money has a job. Every dollar that they earn has a specific job. For the majority of people, the way that their finances look is they make money and then they spend money. And then after they spend their money, they wonder where all their money went. What wealthy people do is they make money, and then some of this money is going to be for their spending purchases. Some of this money is going to be invested, and some of this money is going to be saved. But they have a system that tells them every time they get paid how much money is going to be spent. That way they don't overspend. They know how much money is going to be invested. That way anytime they get paid, they're always working to earn more money, and they have some money that's going to be saved. This is the money that's building their financial cushion. When wealthy people run into a financial problem, they don't start panicking. They have their savings to fall back on. And anytime they get paid, what they're working for is to increase their investments, because your investments are things that you buy that work to earn you more money. For the majority of people, the only way that they earn more money is maybe I'll work hard at my job. Maybe I'll get a second job. Maybe I'll get a promotion. But what wealthy people are thinking is, yeah, I could work harder at my job, but there's a limit to how hard I can work. There's a limit to how many hours I can work. There's a limit to how many things that I can do. But there's no limit to how much money my money can make me. This is what wealth people are always working to increase their investments, because when you buy in investments, now you're buying more money. You're buying something that's working to earn you more money. This is why wealthy people always prioritize this over this. Wealthy people are prioritizing their investments, their assets over a new car. They're prioritizing their investments over a new vacation. They're prioritizing their investments over a new wardrobe. Sure, you can have all the nice things, but first you got to make yourself rich before you make everybody else rich. Once you have more and more investments, now it's much easier to spend money because, well, you have money coming in from your money investments. Your money that your money made is paying for this. It's not the money that you're working to earn. When your money that your money made is paying for your lifestyle, now you are financially free. This is why wealthy people always prioritize this versus broke people, and the majority of people are prioritizing their spending. Broke people are prioritizing looking rich, while wealthy people are prioritizing actually becoming rich. Now, ironically, if you want to actually become rich, you got to sacrifice looking rich right now. I call it the decade of sacrifice, but if you're willing to put in that work, well, now you'll be able to afford all the nice things that you want, and you won't have to worry about the price. Now, to build a system like this, you can create whatever numbers you like. For a simple rule of thumb, something that you might want to start with is something like a 75, 15, 10 plan, which says now for every dollar that you earn, the maximum that you can spend is 75 cents. The minimum that you invest is 15 cents, and the minimum that you save is 10 cents. Now, how do you invest your money? Well, this could be investing money in your own education. This could mean investing your money to pay down other debts. This might be your mortgage, this might be your car payment, what other kind of debts that you have outstanding. This could be putting your money into the stock market. This could be putting your money into real estate. This could be putting your own money back into your own business idea. This could be putting your money into a startup idea. There are an unlimited number of ways for you to invest your money, but the whole idea here is you're going to be investing your money, that way you can grow it. Now, for the majority of people who don't want to be active investors, they don't want to be researching companies, they don't want to be going out and looking for real estate deals, they don't want to be working with startups, they just want to passively invest their money and see their money grow. Well, you have that option with the stock market. You can find some ETFs. An ETF is a fund, a group of stocks that you can just passively invest your money in, because what we've seen is that historically, we have seen the stock market grow by 7 to 10% a year. This doesn't mean that the stock market will always grow by 7 to 10% a year. Some years it will be more, some years will be less. But the stock market in general has grown by 7 to 10% a year for the last century. Well, if you don't want to be actively involved with putting your money into the stock market, how do you do that? Well, you can find a fund that gives you broad exposure to the stock market. Like there's ETFs, funds that give you exposure to the total stock market. There's ETFs that give you exposure to the S&P 500. The S&P 500 are the 500 largest companies on the stock market. You have ETFs that give you exposure to the Dow Jones. The Dow Jones is a group of 30 companies which are in different sectors. There are ETFs that give you exposure to the NASDAQ. There's ETFs that give you exposure to tech companies. There's ETFs that give you exposure to innovation. They give you exposure to emerging markets. They give you exposure to dividend-paying companies. You can figure out what it is that you want to get exposure to, then you can find either an ETF, an alternative to an ETF would be an index fund, or you can also potentially look at mutual funds, but sometimes the fees on mutual funds are going to make them much less attractive. ETFs and index funds tend to have much lower fees, which means typically more money in your pocket. But now this allows you to passively invest your money. Now, if you want to be more actively involved, now you can look at investing in individual companies, which is more risky, but you also have more potential upside, because now if you invested in Amazon and Amazon took over the world, well, now you can see much bigger returns. But if you invest in Amazon and Amazon goes bankrupt, you lose everything. So for people who want to be passive, ETFs can be a good way to go. If you want to be more active, you could look at investing in individual companies. Now, you don't have to pick one or the other. You can do both. Like I invest my money passively and actively. You can also look at investing in real estate and a whole bunch of other alternative investments. But the key here is every time you get paid, some of your money has to be going towards your investments. The last thing that I want to say about this is regarding your savings. When it comes to your savings, there will be a limit to how much money you want to save, somewhere between 3 months and a year's worth of expenses. Once you hit that savings goal that you want, well, then you want to take the savings money and then put it right back here into your investments. The more you invest, the more money you're going to be earning, which means the more money you spend, but also the more money you invest. You create a wheel where every time you spin it, you're going to have more money funding that wheel. This is the compound effect. This is what wealthy people are doing. They're always working to own more of these, which is going to pay them with more money. Now, if you are looking for an easy way to stay up to date on what is happening in the financial markets, you can join something like Market Briefs. Market Briefs is my completely free newsletter to keep you up to date on what's happening in the financial markets. We cover things like the stock market, the housing market, the crypto market, the global economy, and our own economy, and we break it down into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and even if you don't have a financial background, not only are you going to understand what's happening in the financial markets, but you're going to look forward to reading Market Briefs every morning. And the best part with Market Briefs isn't that it's brief, it's that it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. This brings me to step number 4, which is now understanding your debt. Because most people at this point think, well, I'm paying 4% a year for my mortgage, maybe 6%, maybe 7%, depending on when you got your mortgage, but let's assume 4% for my mortgage. But I can go and invest my money and I can try to get a 8% return on my money. So what should I do? Should I invest my money or work to pay down my debt? And this is going to be a little bit more complex than what you might think, because you might say, well, obviously get the higher returns. Well, the problem is this return isn't guaranteed, versus paying down your debt is a guaranteed return. When you pay down your mortgage, you pay down your car payment, you pay down whatever debt that you have, assuming it's consumer debt, you're going to get a guaranteed return on your money. When you invest your money, you have no guarantees. Maybe you get an 8% return. Maybe you get a 15% return. Maybe you get a negative 8% return. You don't know that. So you have additional risk here. This is why if you want to make this decision of investing your money versus paying down your debt, you have to ask yourself now, what's your risk tolerance? What's your investing education level? And what type of lifestyle do you want to live? Because if you come to me and you say, Jaspreet, I want to live big. I want to have it all. I want to be really rich. I want to have a lot of money so I can do whatever I want whenever I want. Well, then you can't be playing small and trying to get this 4% return just to pay down your debt. You got to be working to get bigger, better returns. Now, obviously, you don't want to be foolish with your risk, but you have to take on more risk if you want to see the bigger returns. If you say, Jaspreet, I just want to live financially free. I don't want to have to ever worry about money again. I don't care about having all the big, flashy, nice things. I just want to be comfortable and be stress-free and never have to worry about money. Well, in that case, yeah, work to pay down the debt, because when you have no expenses, now every dollar that you earn can be invested, and it's much easier because now you have no expenses. When you have no expenses, you can live much more free. And this is where now the first thing is understanding what debts you want to pay down, what debts you want to keep. But then secondly, not taking on more debts, not doing the things that got you where you are right now. So not going out and financing things that you don't need, that you can't afford, that aren't paying you. If you're going out and spending other people's money to buy this, well, now you're going to spend the rest of your life paying it off. Use your money to make yourself richer, not your banker richer. But that also applies to something called 0% APR. And this can make a lot of people upset, because people think, wait, Jaspreet, 0% APR, that means 0% interest. If I can borrow money for free, why don't I just go and invest the money and then buy the thing that I want? Like if I can go out and buy this $1,000 phone right now at 0% APR, that means I could take this $1,000, go out and buy an investment and try to get a return on my money, and then only pay $50 a month to buy this. And in theory, it makes sense. The problem is, well, why are banks and businesses so excited about selling this idea of 0% APR? I mean, the most expensive kind of money is free money. And if they're giving you money for free, they got to be making money somewhere, right? Well, yeah. There's a reason why 0% APR is so profitable for companies and is so profitable for banks. Not because they're not charging you any money, because they know that if they can get you hooked on the 0% APR, they can, one, get you to buy more things, and then second, if you don't pay off your debt in time because you bought so many more things, which happens to so many people, now you're going to be on the hook paying 10, 15, 20, or 25% a year in interest. If you just take the cash and go out and buy this thing, you're going to have more financial pain today. But if you go through that financial pain today, you're not going to go out and spend money on things that you don't need and that you can't afford. But if you don't go through that financial pain, well, now you're much more likely to spend money on things that you don't need and that you can't afford. Step number 5 is earning more money. Most people try to start here. They think, I have financial problems, so I gotta earn more money. The problem is, if you don't know how to live below your means, if you don't know how to build a financial system, if you don't know how to manage your debt, earning more money is gonna make your financial problems even worse, because now you're gonna have more money to finance things that you can't afford. You're gonna have more money to live your lifestyle where you're spending money the wrong way, and now your financial problems become worse. That's why for so many people, what you see happen is people work hard to earn more money, and then boop, their expenses magically rose with their income. So this is where now you want to know how to live below your means before you start earning more money. And when it comes to earning more money, the thing that I like to say is, look, this is your income. Let's say you're making $45,000 a year, right? And most people assume that, okay, this is how much money I am investing for my future. And then you start to like this financial education game. And now you say, you know what? I'm gonna try to squeeze more pennies out of my pie. I'm gonna try to invest more. I'm gonna live smaller. I'm gonna do more things so I have more money to invest so I can build more wealth. And you try to just keep squeezing more and more pennies out. But what I want you to start thinking now is not how I can just squeeze more pennies out of my pie, but now how can I take this pie and make it bigger? How can I go from $45,000 a year to $450,000 a year? Because now when you take the same slice out of this pie, now we're talking about way more dollars. You might be going from $10,000 a year that you're putting aside towards your investments and your savings to $100,000 a year. It's the same ratio, but the difference is this is way more dollars. Now at first, when you hear this, you might say, but Jaspreet, how in the world am I going to go from $45,000 a year to $450,000 a year? Well, this goes back to the first thing that we talked about, which is your mindset. First, believing that it's possible, because if you believe it's possible, now you're going to start reading books. You're going to start watching YouTube videos, and then you're going to start trying things. You have to be willing to try things. You're going to work to create your own income, because in this day and age, it is more accessible than ever to create your income. And in this country, you have the freedoms to do that. Now you can try to create your own income. Try to create your own business. Try to create your own product and try to sell it. Now, if you're not an entrepreneur and you say, you know what, Jaspreet, I don't want to build a business. I don't want to build a side hustle. That's not for me. It's too risky. Fine. But now you can look for other ways to earn more money. Maybe you work a second job. Maybe you get a certificate. Maybe you switch careers. Maybe you switch jobs. You switch companies. You got to figure out now, how can you earn more money? But the key here is when you start earning more money, it's what are you doing with this additional money? Are you going to take this money and blow it on a new car and a vacation? Or are you going to take this money and flow it through your system? That way you have more money to invest. The simplest way to become wealthier sooner is when you inflate your income, you don't immediately inflate your lifestyle. Inflate your lifestyle slower than you increase your income, and you're gonna see your wealth skyrocket, because you're gonna have more and more money going towards your investments, and the more money you invest, the wealthier you will become. And this brings me to step number 6, which I like to call be great, where now you finally start to achieve the wealth that you dream of. Now, how can you be great? How can you be great for yourself? How can you be great for your family? And how can you be great for your community? Because the reality is when you have more money, well, you can also do more. It costs money to eat, and it costs money to feed other people. Well, when you have more money, not only can you take better care of yourself, but you can also take better care of your community. So you can give more. But in addition to that, you also want to make sure that you protect your pockets. Because when people realize that you have money, or even when people think that you have money, they're going to try to take their hands, put it in your pockets, and take some of your money for them. So you want to make sure you shield your pockets. This is where you got to make sure you have a good attorney on your side. You want to make sure you have a good accountant on your side. And you want to make sure that you have good insurances on your side, because people will try to come after you. And you got to put up these protections, that way you can take care of yourself, you can take care of your family, and so you can keep taking care of your community. I am a licensed attorney, so I can tell you from my education that America is the most litigious country in the world, and anybody can sue anybody for anything. And then I've also been sued. My real estate company has been sued because we had a tenant claim that they slipped and fell in the bathtub because they said that the bathtub was too slippery when the water was on. And then we later found out that they didn't slip and fall in the bathtub. They slipped and fell at a friend's barbecue, but they were trying to take money from their landlord. These things happen, so you want to make sure you have a good attorney on your side. You want to make sure you have good insurances on your side. And if you are looking for a good attorney, I also have a legal referral business where I can help refer you to a good attorney, whether it's an IP attorney, a patent attorney, a copyright attorney, a business attorney, a real estate attorney, a bankruptcy attorney, whatever it might be. If you're looking for a good attorney and you want me to refer you, I have the link to how you can do that down in the description below. But this is where you want to make sure that you're taking care of yourself, because the reality is is people will try to take some of your wealth for themselves. So you want to make sure you can keep taking care of yourself. So you want to make sure you have the proper shields in place from the right people, the right team. You want to make sure you have the right insurance. You want to make sure you have the right entity structure. And then you have to make sure you have the right estate planning in place. Have a will, have a trust. That way when you die, because everyone will die, you're not going to rely on the government to decide where your money goes. Have the attorney now decide what is going to happen with your money. You don't have to go through my referral. Just find an attorney and take care of this. Spend a few $100s to do that, because the last thing you want is people fighting over your money. Just dictate it and let the world know how you want your money to be divided up after you die, that we don't create family disputes, because I've seen it happen way too many times. Many times, credit card companies have a whole bunch of perks that most people never use. In fact, they bank on people not using the rewards, so I don't want you to be one of those people, and I want you to learn how to use those rewards, because why not get what you pay for? Number 5, I want you to invest in yourself a little bit more aggressively. I used to be very cheap, and I hated the idea